You've poured so much into your business. I mean, building it from the ground up, it's a huge part of your life.
Definitely.
Now imagine this. An unsolicited offer to buy it just arrives out of the blue.
Yeah.
It could be exciting, maybe a little unsettling, but look, it's a situation a lot of business owners are going to face.
It really is.
And whether you decide, oh, okay, maybe this is the right time to sell, or you're absolutely set on continuing your journey, being prepared is just, it's crucial.
That's exactly right. Thinking ahead, it isn't really about predicting the future, is it? It's more about strengthening your business today.
Right.
And making sure you're in a strong negotiating position, whatever comes your way. So today, we're going to dive deep into maximizing your business's value before that unexpected offer even shows up.
Okay.
We've looked at a whole range of expert insights on this, drawing from places like KeyBank, IBG Fox and Finn, DealRoom, Tisch Law, Northern Trust, IAG M&A Advisors, Class Fix Partners, Trestle US Bank, and Zachary Scott. Quite a list.
Exactly. And our goal here is that's such a key point. You have to know what you need before you can even look at an offer properly. And okay, on the business side of things, KeyBank also stresses doing a thorough business valuation. This isn't just a quick guess, is it?
Oh, not at all. No. A solid valuation looks at, current industry trends. Yeah. It analyzes what similar businesses have sold for recently. Those are your market comparables.
Right.
And it critically assesses your business's potential for future growth.
Yeah.
You absolutely don't want to risk selling for less than your company's truly worth just because an unsolicited offer popped up.
Makes sense.
And actually, IBG Fox and Finn pointed out something interesting here, focusing on a niche within a trending industry. That can sometimes command a higher multiple than just being a general player in a really broad market. It's about showing that specialized value.
That's a really interesting nuance. Class 5 Partners also touches on this. They advise you to really pin down both your financial goals and maybe some of those less tangible ones, the qualitative goals for a sale.
Yeah, like what happens to your team?
Exactly, like making sure your employees are looked after or preserving the legacy you've built. And then, crucially, they say, compare those goals to your business's current value. So what happens if there's a big gap there?
Well, that's the crucial part, isn't it? If your current valuation just doesn't line up with what you need or want from a sale, let's say you need, $15 million after taxes to retire comfortably.
Okay.
But your business is currently projected to be worth only, say, $12 million net. Well, then you've got some work to do before you can seriously think about any offers. You need a plan, basically, to bridge that gap and boost your business's value.
Right. You need a concrete plan. And Northern Trust brings up something else that can really hit what you walk away with. Taxes. It's not just about the headline sale price, is it?
Absolutely not.
Yeah.
Northern Trust really underscores the critical importance of considering all the tax implications, how those taxes will ultimately affect your ability to maintain your lifestyle and hit those long-term financial goals. You might get an offer that looks fantastic on paper, right? But what actually ends up in your bank account after the tax man takes his cut? That can be significantly different.
Okay, so step 1. Get a really clear understanding of our own financial landscape, personal, business, taxes. That's essential.
Foundational.
Now, let's think about making the business itself as attractive as possible to potential buyers. IBG Fox and Finn makes a really insightful point here. They say the more confident a buyer is in getting the return they expect, the higher the value multiple they'll be willing to apply. That's basically the number they multiply your earnings by to get the price right.
That's it, yeah.
So how do we increase that confidence?
Okay, well, one key way, and both KeyBank and IBG Fox and Finn really emphasize this, is to reduce the business's reliance on you, the owner.
Okay.
Buyers can get pretty nervous when the whole operation seems to depend just on one person.
Right. The hit by a bust scenario.
Yeah, exactly. So implementing well-defined systems, clearly delegating responsibilities across your team, and building a strong, capable leadership team that signals to a buyer that the business can keep thriving even without your direct day-to-day input.
Makes sense.
And IBG Fox and Finn even highlights the extra security you get from having non-compete and confidentiality agreements in place with that key management team. That really helps assure a buyer that talent sticks around.
That makes a lot of sense, yeah. A business that can run smoothly on its own is a much less risky bet. What else do buyers look for to feel confident?
Financial transparency and just overall financial health are absolutely critical. KeyBank stresses optimizing your financial records and reporting.
Clean books.
Clean and accurate books, up-to-date financial statements like your P&L, tax returns. These build a strong foundation of trust. And as KeyBank points out, having your financials audited by an independent firm, that provides an even greater level of assurance,
Right.
which can potentially speed up the due diligence process and maybe even lead to a higher valuation. Building on that, IBG Fox and Finn really hammers home the need to, as they put it, clean up your room financially.
Ah, okay. What does that mean?
It means making sure your inventory and asset records are accurate. They actually match what you physically have. Strengthening key financial ratios like working capital, debt to equity, and crucially, removing any personal or non-business expenses from the company's books.
Ah, those perks.
Yeah, those kinds of, let's say, creative accounting practices you might have used to minimize taxes before, they can really raise red flags during a sale process.
Okay, so getting your financial house in impeccable order is non-negotiable. Got it.
Okay.
What about the lifeblood of the customers?
Right. KeyBank advises focusing on strengthening relationships with your key customers, having solid contracts in place, and proactively addressing any risks related to customer concentration. That's vital. IBG Fox and Finn even puts a number on it. Ideally, no single customer should account for more than, say, 10% of your total sales.
100%.
A diverse and loyal customer base demonstrates stability and reduces risk in a buyer's eyes.
Right, so you don't want all your eggs in one or two client baskets. Makes perfect sense. What about the nuts and bolts, the operation itself?
Operational excellence is another key area KeyBank highlights. Reviewing and strengthening your core operational systems.
Okay.
Thoroughly documenting your key processes, identifying and getting rid of any bottlenecks or inefficiencies, and ensuring your business model is actually scalable for future growth.
Scalability, right?
All these factors make your business more attractive and, frankly, much easier for a buyer to integrate smoothly. IBG Fox and Finn echoes this. They advise documenting everything from job descriptions and daily procedures to your overall strategic plans. Buyers want to see a clear, well-documented roadmap for success.
It really does seem to come down to making the business as predictable and kind of low risk as possible for the buyer.
That's a huge part of it, yeah.
What other potential red flags do buyers typically look out for?
Well, potential risks and liabilities are definitely high on their list. KeyBank emphasizes minimizing any legal, regulatory, financial risks, things like pending lawsuits, unresolved compliance issues, outstanding debts.
Right, the skeletons in the closet.
Exactly. Transparency in dealing with these issues proactively are crucial. Showing you've already addressed potential problems can really smooth negotiations.
Okay.
And we can't forget it about protecting your intellectual property. Both KeyBank and IBG Fox and Finn stress legally protecting and thoroughly documenting any patents, trademarks, copyrights, trade secrets your business holds. IBG Fox and Finn even calls IP a valuable hidden asset.
Hidden asset. Interesting. Okay, so from rock-solid financials to streamlined operations and protected IP, it sounds like de-risking the business is a major factor in getting a higher value.
A huge factor.
Now, let's just focus a bit. Let's talk about how strategic growth and having a strong market position can impact value. IBG Fox and Finn had some really interesting points here, didn't they?
Absolutely. They advise actively focusing on growing both the overall size of your business.
Bigger is better.
Often, yeah. Aiming for annual sales over $5 million and EBITDA, that's your earnings before interest, taxes, depreciation, amortization, a key profit indicator above $1 million, tends to attract a wider pool of buyers.
Okay, hitting those thresholds.
Right. And also growing its scope, developing new relevant products or services, strategically expanding your market share, demonstrating agility, successfully seizing opportunities in new or existing markets.
Yep.
That also adds significant value.
Makes sense.
And of course, having a strong, consistent track record of growth just speaks volumes to potential buyers.
They also really emphasize the importance of deeply understanding your specific market, don't they?
Yes, staying on top of your market is absolutely critical. It means having a clear grasp of the industry size, the key trends, who your main competitors are, what your market share is, your specific niche, any significant barriers to entry.
Knowing your playground.
Exactly. Being able to articulate all that clearly to a buyer helps them understand the value and the potential you build.
And it's not just about the hard numbers, right? Building a strong reputation, brand recognition that plays a big role too.
Totally. IBG Fox and Finn talks about making a name for yourself, consistent brand recognition, strong customer awareness, established relationships, a positive reputation in your industry.
Even if you're not a household name.
Right. You don't need to be Coca-Cola, but having positive recognition and goodwill in your sector really enhances your perceived market value. Plus, putting your strategic plans down on paper business plan, financial projections, personnel strategy, and clearly articulating a compelling vision for future growth, that gives buyers a lot more confidence in the long-term prospects.
Documenting the vision.
And they also remind you to spot and leverage other potential hidden assets, maybe strategic alliances, successful joint ventures, any particularly innovative practices you use.
Okay.
And a practical piece of advice they offer is to be lean and mean, strategically outsourcing non-core functions to improve efficiency and ultimately your true cash flow.
Focus on what you do best.
Precisely. And finally, a very practical tip. Clean up your room.
Again with cleaning the room.
Yeah, this time it means selling off unproductive assets and making sure your physical property, your facilities, look well-maintained and presentable. First impressions matter.
It really does sound like being truly prepared to sell is fundamentally just about running a high-quality, well-managed business in the first place.
That's a great way to put it. They really go hand in hand.
Okay, now let's think about when that unsolicited offer actually lands. DealRoom offered some interesting insights into the current M&A landscape.
Yeah, DealRoom highlights this significant upcoming wave of business sales. It's largely driven by baby boomer retirement.
Right, the silver tsunami.
Exactly.
Yeah.
Which is creating a pretty substantial opportunity for businesses looking to acquire.
Yeah.
So for you as a potential seller, this active market just underscores how important it is to be prepared to capitalize on that demand.
Be ready when opportunity knocks.
Right. And they also suggest a really valuable exercise. Put yourself in the buyer's shoes. Honestly assess your own business as if you were considering acquiring it.
Turn the tables.
Yeah. Think about your own experience, your management capabilities, your risk tolerance. It's a powerful way to spot potential weaknesses in your own setup from a buyer's point of view.
That's a really smart way to get some perspective. Okay, following on from that, Northern Trust outlines some of the most common reasons why business sales, unfortunately, end up failing. It's a bit sobering, but crucial to know, isn't it?
It certainly is. Things like internal family conflicts about whether to sell.
The family dynamics.
Yeah, or a lack of a clear, viable management succession plan. Losing key employees during the sale process, that's a big one.
Yeah, that could spook a buyer.
Definitely. Significant concerns from the buyer about your financials or your projections. Unexpectedly losing major customers during the process. Critical issues discovered during due diligence, think environmental problems, surprise litigation.
Nasty surprises.
Right. Inadequate support from experienced advisors. The management team getting so distracted by the sale they drop the ball on day-to-day operations. And as we mentioned, unanticipated negative tax implications. These are all significant hurdles that can potentially derail a deal.
Wow, quite a list of potential pitfalls. And Tisch Law then dives into specific legal pitfalls that owners need to avoid. These sound equally critical.
Absolutely. Inadequate due diligence, and this cuts both ways. Buyer and seller is a major one. For sellers, it means not having your records organized, not addressing potential legal issues before you go to market.
Your ducks in a row legally.
Exactly. Poorly drafted purchase agreements, vague terms, missing essentials like non-compete clauses, that's another big risk. Failing to properly identify and address liabilities and jets. Overlooking critical employment issues, contracts, benefits, transfers, labor laws.
Lots of HR details.
Huge details. Not thoroughly considering all the tax implications. Failing to comply with regulations or get necessary approvals. Not having a clear, documented transition plan. And maybe most importantly, trying to navigate this whole complex process without experienced legal and financial pros. That can lead to serious, costly problems.
It really hammers home the need for a strong team of experts guiding you. IAG M&A Advisors explains the role these business sale advisors play.
Yeah, they essentially act as your expert guide and advocate through the whole thing.
Your quarterback?
Kind of, yeah. Their role covers everything from doing a thorough valuation, actively finding qualified buyers, skillfully negotiating the terms, and expertly steering you through the often complex closing process. Their market knowledge, their ability to position your business attractively, it's truly invaluable.
Right.
They also help navigate the tricky financial implications, capital gains tax, the details of seller financing through seller notes, all that stuff.
And Class 6 Partners strongly recommends assembling a whole team. A seasoned deal attorney, a qualified accountant, an experienced financial advisor, maybe even an investment bank, depending on the deal size. It really sounds like going it alone is just asking for trouble.
That's the clear consensus among all the experts we looked at. Their specialized knowledge and experience are pretty much essential for a smooth and successful outcome.
Okay, let's circle back to something we touched on earlier, taxes. U.S. Bank really drives home that crucial point.
Yeah.
It's not just the headline price, it's how much you actually keep after taxes.
That's the bottom line, isn't it? They clearly explain how federal and any state capital gains taxes can significantly bite into your net proceeds.
Right.
Your business's legal structure matters hugely here too, whether you're an LLC, partnership, S Corp, or a C Corp. They all have different tax implications in a sale. And then there's the type of sale, asset sale versus stock sale. They have very different tax consequences for both seller and buyer. U.S. Bank particularly highlights the potential double taxation risk with C Corp in asset sales. That can be painful.
Double taxation, ouch.
Yeah.
And the form the payment takes also has tax implications, right? Cash versus other things.
Exactly. Cash at closing is often simplest for the seller, but other forms like a seller's note where you finance part of the price or an earnout based on future performance, or even rolling over some equity into the buyer's company. Each of those carries different financial risks and also creates different opportunities for future tax planning.
Huh.
U.S. Bank even mentions the strategy of maybe moving to a no income tax state if you're getting paid out over time via note or earnout.
Interesting angle.
And they give a really important reminder, don't forget other potential taxes like estate tax implications. Having a current, well-thought-out estate plan is critical.
So tax planning needs to be woven into the whole preparation process, not just an afterthought.
Absolutely integral.
Okay, finally, let's talk about the broader benefits of doing all this proactive prep, even if you have zero immediate plans to sell. Zachary Scott makes a really compelling case for this.
They really do. They argue persuasively that taking the steps to be ready to sell now actually translates into significantly greater overall value and more success for your company, period, regardless of whether you intend to sell anytime soon.
How so?
Well, the very act of planning for a potential sale forces you to adopt that critical buyer's perspective.
Right, thinking like they think.
Exactly, which naturally leads you to identify and clean up any existing loose ends or weaknesses in your business. They even share a great real-world example, Da Vinci Gourmet. They were able to sell quickly and successfully precisely because they'd always run the business with the discipline as if it were constantly ready for sale.
Always being ready. So what are some specific benefits Zachary Scott highlights from that approach?
They emphasize the big reduction in perceived risks for buyers when you have things like a diverse customer and supplier base and real depth in your management team.
Makes sense. Less risky.
They also strongly advise separating any real estate assets from the core operating business. Makes valuation much cleaner.
Okay.
Ensuring you have consistently high-quality, accurate financials, maybe with independent verification, especially for inventory, and diligently tracking and ditching non-essential costs. Also crucial.
Quality numbers.
Right. Maintaining flexibility in your legal structure, pass-through entities like LLCs or S Corp are often preferred by buyers for tax reasons in asset purchases. That's another key point. And finally, ensuring the clear transferability of rights for all key contracts and IP, and diligently managing and documenting any potential contingent risks, warranties, lawsuits, environmental stuff, regulatory issues.
Covering all the bases.
Creating what?
So it really does all come full circle, doesn't it? Being truly ready to sell isn't just about having an exit plan. It's fundamentally about building a more resilient, more valuable, just a better run business overall.
Precisely. By proactively focusing on strengthening your financials, improving operations, actively reducing risks, pursuing strategic growth, you're really taking much greater control over your business's future.
Right.
Regardless of whether that future includes a sale or just continued success under your ownership. The real aha moment here, I think, is realizing that most of the steps you take to prepare for a sale, they're simply fundamental best practices for running any thriving, sustainable business.
That's a great takeaway. So as you're listening and reflecting on all this, maybe consider this. Which one or two of these preparation steps could potentially have the biggest immediate positive impact on your business's value today, even if selling isn't on your radar right now?
Yeah, good question.
Maybe it's finally getting those financials audited, or perhaps it's developing a concrete plan to diversify your customer base. We really encourage you to explore those specific areas further.
Definitely. And if you find yourself with more questions or want to dig deeper into specific things we talked about, like valuation methods or the nitty-gritty of tax implications, please feel free to revisit parts of this deep dive or do some more targeted research. Our main aim here has really been to give you a valuable shortcut, a way to be truly well-informed and much better equipped for whatever the future holds for your business.